Awesome. All right. Well, thank you guys for joining the Really One Stop Mastermind group. And today is the 14th of December, 2022. And we're going to be interviewing Phil Weichert, who is a CPA based in Cincinnati, Ohio, who focuses on real estate investing himself and advising real estate investors and other business professionals on their tax strategies and tax filings and tax returns. So thank you so much for joining us tonight, Phil. And kind of the plan tonight is to have about a 30 to 40 minute interview and discussion with you, and then we'll open it up for Q&A with the rest of the group. And then if you want to stick around, we do a group discussion where we kind of talk about our own personal goals and progress from the last meeting that anyone attended. So we have calls every 2 weeks, so we talk about the progress between those. So you're welcome to hang out, and we try to wrap it up about between 10 and 10:30 at the latest. So obviously if you have to go, feel free to jump off whenever you need to. Anyway, so to start us off, if you don't mind adding a little bit more to your background and your bio, and tell us a little bit about yourself and what you're doing.
Yeah, well, first off, thank you for inviting me, and see some familiar faces and names. So it's good to see everyone. And if I haven't met you before, my name is Phil Weichert. I'm a real estate investor, and then as well as a CPA specializing in the niche with real estate investors. So background, going back to 2013, and I'm going to make the joke real quick. Colby was in the office earlier today, and I told him he's going to hear the same spiel. So if he jumps off, it's probably because he's listening for the second time in the matter of a couple of hours. So I started in the tax world in, 2012. I was working for Deloitte and Grant Thornton. So I was 2 years at one and 2 years at another. So I was working on the Fortune 500 company, and as well as the large mom and pop shops. And during that time, I started investing in real estate, fell in love with it personally for investing. But then at the same time, I was able to really enjoy helping, just individuals. They were asking questions or trying to figure out the best way to maximize taxes, as well as just helping think through different investments. And so after 4 years of working for the big guys, my goal is to go on my own. I didn't know how to go from the big CPA firms to a local one or starting my own. And so I found a local CPA that took me under his wings, and it was about 2 years with him. Got to learn the ropes on, working with small individuals to medium-sized companies. And it was just a great experience. And after 2 years, I decided to spread my wings and started Strategic Tax Services. I would say at that time, about 80 to 90% of my clients had real estate investment of some sort, anywhere from buy and hold, flipping, wholesaling, one single family to, a couple hundred units. And I think the first year, maybe not even the first year, I was right around 30 clients. And then by the end of year 2 was about 180, and then over 300 by the end of year 3. And really just found that niche because, one, I was constantly looking for ways to tell the banks, hey, I want to use my rental income to show a higher debt to income ratio, but at the same time, just networked with anyone and everyone. My wife likes to joke that I would have a pre-coffee, a coffee, a second and third coffee, then have a breakfast, have a pre-lunch, lunch, and I just networked with anyone and everyone for about a year straight. And there was a lot of positive, a lot of great people I met, Joe, Nathan, Dylan, got to meet, those guys throughout those years. But I grew to a point where I needed to figure out, okay, do I hire or what's the next step? And so in 2021, merged my company with another CPA firm, another young CPA who was buying out his partner, which was a whole new brand of struggles. It was right in the middle of COVID. And so, but we got that done in 2021. And now I have a team of 6 full-time employees, one being myself, and then the other being my partner. And then we have 2 seasonal employees. Looking at our overall client list, we're about 60% real estate. And most of that comes from, just clients that I work with and or my partner, Rob, not necessarily transitioning to me, but I usually consult a lot with that, with those clients. And so from the tax standpoint, I've been able to really just help out clients from tax savings to strategy to just understanding how we get, lenders to work with them. I've written a lot of letters to banks to try and help them understand why the taxes are so low due to depreciation, cost segs, all the way to a ton of clients that have K1s and how distributions, aren't income, but at the same time should be treated as a way to show income for lending purposes. I had some good success with that, and at this stage, just trying to continue to help clients invest. Transition real quick to my real estate journey. So in 2013, bought my first house. It was a single family, 3-bed, and I rented out 2 other rooms to some friends. And so house hacking right off the get-go. A month later, bought my first official rental, where I was able to just get the experience. The nice thing, it was 2 doors down. So every day I would come home, got to look at it. And I was really fortunate, got a really good tenant that first one. A year later, bought a second one. Then a year after that, I partnered with someone for about 6 properties. So we were 50-50 partners where, and of the 6, one of them I wasn't able to come up with the cash that he did. So we ended up just transferring it back to him. One of the other ones we ended up wholesaling. And then by the end of that first year, we were able to do a cash out to repay each of us back our 70,000 we put in. Then 2 years later, we were able to do another cash out on the remaining 3 or 4 that ended up buying us 2 4-families and giving us cash to set aside for another investment. Around I think in 2018, that same year, I was able to buy an 11-unit off-market deal where the seller did the note. So it was a seller finance off-market deal, and I think we negotiated with 10% down, 5.5% rate, and then a 5-year arm amortized over 25 years. And so it turned out really well. I was able to, one of them was dependent if I was going to hold it or not, but I ended up selling that one of the 2 off just to ease the pain, because that one I sold probably was 80 or 90% of all my problems within the real estate game. And it just didn't make sense to keep holding, especially once I started getting some cost on the roof and some of the types of gutters, box gutters, and so forth. And so at one point I was at 29 units. Now I've kind of been selling off and putting that money into kind of a partial syndication with the guy that I was a 50-50 partner on, which that one is a 54 unit over in Delhi. And so that's kind of a quick rundown between the tax and the real estate.
Awesome. Well, thank you for your background. And mainly I want to demonstrate that, you approach the CPA business from an investor standpoint because that's your background, right? So that's kind of the point I want to establish here. Obviously, I know you, but the audience doesn't. So one of my first questions, I think kind of the most important thing to establish is, I think a lot of people, myself included, look at taxes as like a burden and frustrating and annoying. So most people probably don't have a very passionate, let's say, feeling towards doing their books and their taxes and things like that. But can you talk a little bit about, just generally speaking, why you feel taxes and having a good tax strategy is so important, especially related to real estate investing?
Yeah, I think the first thing is, when we think of cash in, cash out, we see these nice profits. We see, if it's a cash flow, a flip, a wholesale, and or selling a property, we see this cash coming in, like, wow, this is great. But all of a sudden, Uncle Sam wants his money, and you're like, okay, did I really make any money? And why am I doing this? And so I think understanding the, not just understanding, hey, there's a tax piece to it, but also understanding, how can I be prepared? How do I know, Like if I make money, I should be setting aside a certain percentage. And so by treating the old mentality of taxes are past tense, let's change it to say, hey, it's future, or present tense. How do we just make sure that we just understand it? And so yes, it's a burden. Yes, we hear all the stuff on the media, good, bad, whatever it might be, not to go down the political route, but in a way, taxes fund the government. And so when you see stuff go on, you start to say, hey, where's my dollars going? Or why do I have to give this money up? I'm just trying to provide for my family, or I'm trying to build a future for my kids and or grandkids. And so it's just changing the mentality of, well, if we can control it the best we can, and that's in anything. I mean, think about your tenants. It's not to say you control them, but it's through your leases, you're trying to control what they can and can't do. And so by understanding that lease, the tenants can now say, hey, I can do X, Y, Z. They're comfortable with it. And the same point is, if we can understand taxes enough, especially from the taxpayer standpoint, or having a good CPA, now we can understand it and help control the situation.
So if you were going to kind of summarize, let's say for like a new investor, because a lot of the people in this group and a lot of people who watch these videos are newer investors. If you were going to summarize, let's say like the three most important thing a newer investor could do, let's say they have a couple properties or maybe in their first property, what would you advise them? Like, again, just like the three most important things to do as a new investor on a tax standpoint.
Okay. I'm glad you added the tax point, because I had some other thoughts too. I think the key is being organized. I will admit, I am probably my worst enemy for my personal side. I mean, it took years to get into a habit of putting receipts aside or using the same bank account or credit card, just because I get done working with clients all day. I don't even want to think about my own. And so what I've learned, I'm going to speak more of myself and what I've seen from clients, is by being organized, you're not missing out on deductions, because we can't necessarily create deductions. But if it's, hey, I spent this money, but I used this credit card over here because it gives me great rewards, but then 2 weeks later you lose the receipt, you forget about that transaction. Well, then when it comes to tax time, you're like, oh, I don't know, I probably spent a couple extra $100. Well, those $100 start to add up. So I think organization, but I think the second one is changing the way we think. And I was talking with Colby about this earlier. So the IRS, when it comes to audits from taxes, it's all about intentions. What are your intentions for spending that money? Well, I think the example I used earlier was a tool. So let's say you need to buy a tool for your personal house. But if you just tell the government, hey, I bought it for my personal house, well, that's a personal use. It's not a deduction. But if you just change it, tweak it just enough and say, actually, I purchased it to do this project on this rental, and I happen to use it on my personal house, well, it becomes a deduction. So changing the stories. And another example could be meals. Hey, I'm going out with DJ over there to have a drink, or grab a burger. Well, if we're just talking to figure out who we are, that might be a bit more personal. But if we start talking about real estate, talking about taxes, it's the intention. So by changing that intention, so I think that's the second piece. And then I think the third one I would say is know your advisor and know that they know their stuff. So there was a client that left 2 years ago, and he just called me the other day and said, hey, I want to come back to you. And he goes, I've tried 2 other CPAs and they're great from doing the tax work. But when I try and say, hey, let's do a cost seg, or let's do this, and again, this is the client bringing it to him, the CPA is like, well, I don't think that makes sense, or yeah, you shouldn't do that because that's going to hurt you down the road. But again, and he's not giving bad advice, but he's giving bad advice for a real estate investor that wants to grow. And that's the key, is understanding the real estate industry, but understanding the tax side.
Awesome. And so is there anything aside from the organization standpoint specifically? I mean, I guess we could talk examples. One thing that I did a couple years ago was I transitioned every one of my properties to a separate bank account. And then for my businesses, I opened up separate business credit accounts. So therefore, everything runs through one specific either bank account or credit account, and then they're obviously attached. And then I transition everything to bookkeeping or QuickBooks for my bookkeeping, which allows me to automatically pull that data. And so I don't want to get too into the weeds, but things like that, whether you're just starting out, maybe you're still using spreadsheets. I think you remember the first couple of years we worked together, I was probably still working off spreadsheets, and I was sending you, my books through that. Obviously, as it got a little bit more complicated, then I had to try to minimize the amount of time I was spending on bookkeeping. But so having an organizational system, whatever that looks like, but like, let's say you're a brand new investor and you have one property, would you still recommend somebody trying to separate out personal and business expenses related to that property?
Yeah. So I think the separate bank account, not necessarily by property to start off with, is important. And so disregarding if you have a single member LLC, if you have it on your personal name, a trust, the biggest thing is we have a personal bank account and we have a business bank account. Business being single member LLC, being personal, rental, trust, whatever it might be, is totally separating them. One, for the organization, it's going to help. So at the end of the year, you can go through and review all 12 months. Quick, I have everything. And then the second piece is I'm not an attorney, so always consult your attorney. But I believe what I've seen and what I understand from an investing standpoint is the more you can show that it's like a business, so that one bank account, then it allows you to perceive as a business to if it's attorneys, if it's the banks, if it's anything like that. And so again, personal, aka if that's Joe's travel money or just daily living. Business could be the rentals. Now if you want to get more complicated or make it easier to track, then that's where you do one per property or per LLC or per whatever it might be. But I think the key is separating those two, just so that way the organization as well as the perception to others, it looks better.
Okay, that makes sense. So shifting gears into a little bit more advanced type of strategies. And you don't have to give an exact number, but I want to kind of lead us down to the point of why this is important for a lot of investors, especially as they scale. So do you have any idea off the top of your head, if you could just, pick a client or a hypothetical client, how much real estate investing in like one tax year could potentially save you?
So you're saying like
Like
buying
let's
a
say
new
cost
property?
segs, yeah, like
Yeah.
whatever, it could be obviously a bigger property or whatever, just as an example. I just want people to kind of wrap their heads around the potential savings that are out there as you scale.
Yeah, it's interesting because I like to be too critical or overanalyze. And so when I think of that question, I'm like, well, first off, it can depend on everyone. And so a client of ours recommended looking into a competitor that does cost segregations. And so Max in our office, he's our new accountant, and he goes, or I suggested to him, I was like, why don't you sign up for their free quote and see what comes back? And it was interesting is they used just the highest tax rate and said, here's what you can potentially save. Yes, it makes sense for my eyes, but if I told Joe or Colby or Angelo or Nathan, if I was like, hey, you're going to save this amount in taxes, but that's if you're in the 37% bracket, and if that small asterisk, now all of a sudden it's like, well, does it really save you that much? And so I would say, to answer your question, depending on the scenarios, I would say a cost segregation on average probably saves at a minimum 6 to 7 grand in taxes. And that's at like bare bones, a property that really doesn't have much to work with, and or you're more at a lower tax bracket. And that really only works to get those if you're doing it when the bonus depreciation is around, which this is the last year for the 100%. However, next year's 80%, which there's still a major impact for next year. It's just, it starts to change as we think about it. And there's been clients or new clients or other clients, we've been reaching out to a lot of our clients. Max has actually been reaching out this week to say, hey, we're starting to think about next year, or should we amend the prior years? Because we really think we can go back and help clients where it might not have been in the forefront in the middle of April or March, but can we get you some more money back? Because if you're looking to invest in the next property, again, you can take that cash, and cash is king in real estate. So if the minimum is 5 to 6 grand on a first year property, I think it makes sense for a growing investor. If you're not a growing investor, then there's other strategies, but it might not be the cost segregation.
Okay. And so, again, I know we're talking hypothetical here, but potentially, if you had several properties and you were doing cost segregations on them with let's say in this tax year, then you could potentially wipe out all or most of your tax liability, really up to basically an unlimited number, hypothetically, assuming your income, was high enough to offset that, and you had bought enough property of enough, significant size and cost. Is that, again, in a hypothetical world, that makes sense, right?
Yeah, and the only thing I would add is that if you Google it or anything like that, you'll see it depends on the passive activity loss rules, which is going to be where the real estate professional or the active. But let's just say someone that is a real estate professional, or let's say in a married couple, one or the other is a real estate professional, the other's W-2. Yes, hypothetically, you could erase all of it, and I've done that many times with clients where we've taken it and eliminated. I think the biggest change in 1 year I've seen is 115,000 we've removed.
So that would have been owed, but because of the accelerated depreciation through cost segregation, you were able to completely wipe out that size of a tax liability.
Correct.
Awesome. All right, and that's kind of what I was hoping to hear. So backing up a little bit, just in case anyone watching this doesn't understand, can you kind of briefly summarize what depreciation is and how it's typically used, so we can kind of contrast that with cost segregation?
Yeah. So depreciation is you're pretty much spreading your purchase price over a certain amount of years. Now, the years are determined by the IRS. So for residential property, it's going to be 27 and a half years. Commercial is going to be 39 years. If you have a mixed use building, the IRS actually says you need to qualify for that 27 and a half years, 80% of your gross revenues has to go towards residential, and then 80% or more, and then you can qualify for that 27 and a half years. So we're just spreading the original purchase price over that lifetime. And then the cost segregation, because Joe, you kind of hinted at that, is when you buy that property, there's going to be certain types of floors in there. There's going to be certain types of, or there's going to be kitchen cabinets, countertops, appliances. There could be fence, landscaping, driveways. There could be all those different things that you're buying, but without a cost segregation, you're pretty much telling the government, hey, I bought land in a building, and so we have to depreciate over that 27 and a half years. Well, by doing the cost seg, we start to pull out those bits and pieces. And so if you buy a property for 200,000, we say, okay, X amount for appliances, X amount for kitchen cabinets, X amount for this, and this. Well, that 200,000 is still going to be depreciated, but the difference is maybe 20,000 or 30,000, whatever the number comes out to be, is going to be that 5 year, which is going to be more your appliances, kitchen cabinets, floating floors, carpet, countertops, things like that. And then the land improvements are going to be more your landscaping, your sidewalks, driveways, retaining walls, items of that nature. And so by doing that, especially in the year of bonus depreciation, anything that's and when I say 5 and 15, those are a section 1245, a bit more detail than you need, but that's just the section code it's under. Those are deemed tangible personal property versus the 1250, and I can't remember off the top of my head, but those can be then bonus depreciated, which means that's where those big savings are. So as you pull those out, now all of a sudden we get to take it all in that first year.
Okay. And so let's say I bought a duplex for 100,000 and I put $25,000 of work into it the first year I owned it. How would that then be allocated within the depreciation schedule?
So if we did the cost seg and then
let's just say we didn't. Let's just say typical traditional depreciation schedule. How would that work?
Yeah. Yeah. So that 100,000, we would break out a little bit for land. Quick math could say 10 or 20% depending on the area. And so you're left with 90 or 80,000 and that's depreciated over 27 and a half years. Then depending on the remodel and what's all doing, but let's say it's a full gut, then we could, if Joe or Nathan provided receipts and said, okay, this is the amount, like, so you guys as the taxpayers can do a cost seg by just keeping track of your receipts and saying what each item is. But if you just hand it to me and say, hey, this was a full gut, then most likely we're just going to depreciate over 27 and a half years. Now, me and my team are trained to say, okay, Joe, for this amount you spent, I know you had to buy appliance. There's a kitchen cabinets or something like that. So can you just give me, break out the big numbers so we can speed those up. But again, if there's no evidence or, hey, this is the number, and Joe doesn't feel comfortable to go through his receipts and figure it out, we're going to depreciate over 27 and a half years. So we're talking maybe only $1,000 or $2,000 worth of deductions a year. And so it's really small versus being able to say in year one, I can take 30, 40, 50,000. It's a big difference, major difference.
Okay. So you're saying that in theory, traditionally, let's say, historically with the tax code, most of that expense, let's say on a $25,000 rehab and $100,000 purchase, would have just been added back to the cost basis, which would then just basically fall into the typical depreciation schedule. Am I understanding that correctly?
Yes.
And then the cost segregation allows us to accelerate that 27 and a half years to certain items and fixtures that we can then expense in year one, but is still counted as depreciation.
Correct. Yes. And that's where, when we start talk to lenders, the more we put into that depreciation line, so that the 5 year or 15 that we can depreciate through the depreciation line, but use the bonus depreciation. I think it's line 15, it hits depreciation. When lenders look at that, they add that back to whatever your net is. And so the reason I'm going down this road is there's a difference between taxable income and lendable income. And so if your taxable income is $1,000, well, initially it's like, well, the bank's not going to really help me out there with only $1,000 of income. Well, add back of that depreciation. So if in year one, you have 10,000, 20,000, whatever it is of depreciation, now it looks like you have 11 or 20 some thousand of lendable income, because depreciation is not a cash flow situation in the lending world.
Yeah, and that's super important. And obviously my own personal experience and what I am attempting to do this year, obviously working with Phil, is to make my tax liability as close to zero as possible, because I want to take that money I would spend in taxes and use that to continue buying more real estate. And so to accomplish that, I'm going to have to do cost segregations on some of my purchases from this year. And hopefully that will be an adequate amount to offset the tax liability that I would have otherwise.
And I think one other thing to add is you don't have to do a cost segregation in the first year. You can do, like, so if you bought a property 10 years ago, you can do a cost segregation today, but the difference is where that expense hits. And so while we're talking about, the lending, there's also that tax liability. And so, yes, we can get that tax liability down, but if you're getting ready to submit that 22 tax return to the lender, and they see this expense, now all of a sudden they might not be willing to lend to you because they don't understand this line item. And so it's called a 481A adjustment. It just hits other expense. I've written lots of letters to the bank saying what it is. And every time they're like, we don't understand it, so we don't feel comfortable adding it back. And so Joe and I've talked about some prior properties. Even though there's a great benefit, it would really hurt his lending ability right now. And so that's where, Joe was bringing up between a current year property hitting the depreciation line versus a prior year, it's going to hit a different line item.
Yeah, and to me, this is probably one of the strongest strategies that at least I've personally seen as a real estate investor. And obviously, there are some caveats to that I understand, and I know you mentioned it briefly. So talk a little bit about what is a real estate professional and how would that differentiate from somebody maybe just working like a regular 9 to 5, and what are the limitations if they're not considered a real estate professional?
Yeah. So real estate professional, there's lots written in there, but the main ones you got to hit is you have to have 750 hours within the real estate industry. So that's roughly, I think it's about 14.4 hours per week. And the critical is and more time than any other industry. So if you have a W-2 job and it's full time, what is it? 2080 is the expected hours per year. If you hit 1,000 hours in the real estate industry, but you have a full-time job at 2080, you still can't qualify. Now, there are certain industries, or I should say industries, jobs, such as if you are working in residential construction or you're a real estate agent, because those are still in the real estate industry, those count towards your hours as well. But the key is at minimum 750 and more than any other industry. So, unfortunately, even though I work with real estate professionals every single day, and all I do is talk about real estate, because I'm in the finance industry, I can't classify as a real estate professional.
And I also understand that has to be active participation in those investments, right? So like even if somehow you accumulated 750 hours and you had no other income or no other business or job, passively investing, let's say in syndications, from my understanding, that would not qualify as well.
Correct. One piece that always shocked me that doesn't qualify, like talk about the different areas. One area that always shocked me is actually time spent getting loans. That does not count towards real estate professional. They consider it more part of like investing or you're managing. Even though management is acceptable, it's the time spent looking for loans doesn't qualify for that 750. But yes, what you said before is correct, Joe.
Okay. And so let's say, again, like I said, a lot of the people who watch these are new investors. So let's say you got maybe a couple of properties, but you're still working a full-time job and something non-real estate related. So now what limitations fall on you with some of these strategies that we're talking about?
Yeah. So if your income is 100,000 or less, and that's single or joint. So if you're married or single, they don't double it like they do on most things. If your income's below 100,000, then you can take up to 25,000 a year if you're active. Now, active terminology for this versus the real estate professional is slightly different. They're saying you have to hit 250 hours per property, or you're doing at the most work on those properties. And the reason I bring that up is the law says 250, but there's been many court cases where the IRS has tried saying, hey, this person did not do 250 hours. Well, if you looked at total time spent on the property with managers or contractors or whatever it was, the owner still did 90% of the work. And so the court said, hey, you still classify for this active real estate. And so again, if you're doing most of the work on the property, you're most likely going to qualify for that. So a new investor, and I'm thinking more of myself, when I got in, I was working on the leases. If a light bulb went out, I was the one running over. If every once in a while I'd hire someone else, but I was the one running and doing everything. And so I classified as that active real estate professional. And so if your income's 100,000 or less, you can take up to 25,000 losses to offset W-2, retirement, whatever it might be. Once we hit over that 100,000 up to 150, we start to decrease that 25,000. So every 2,000 above 100, you lose 1,000 off the 25,000.
Okay. And now if you are a real estate professional, what are the limitations?
The only limitations is going to be the net operating loss rules and the business loss rules, which for single, I think it's 250, and married it's 500,000 of losses. So we're jumping into more like the business area. Hey, we're losing this type of money, so we can't necessarily carry it over. And if let's say this year Joe had a $500,000 loss or $499,000 loss, it erased all other income, and so we're showing it NOL, net operating loss. He gets to carry that all forward, and so in all these scenarios, you don't ever lose the losses. It just gets carried forward. So the active or the real estate professional, whatever you can use in the current year, we use, but then everything else gets carried forward. And so, yeah, the real estate professional is a really nice gig. but that's why they have strict standards saying you have to hit these hours, because you can literally take everything to offset your income.
And I think my last question on this vein is, if you are a non-real estate professional and you're just, maybe a newer investor, you can still carry forward those losses and then use them. Let's say you go 5 years and you don't buy another property, or maybe you have a little bit more income that you're trying to offset. You can carry those losses that you didn't qualify in previous years forward. Am I understanding that correctly?
Correct. So
Okay.
let me just say like a scenario. So let me use myself. So the first one I bought, I didn't do a cost save, but let's say I did, and I had a loss of 50,000 in year one.
Mm-hmm.
Well, I couldn't use it in year one. So year two, let's say I could use $1,000 because that's what my net profit from the real estate or however it worked out. So now I'm going to carry forward to 49 moving forward. Well, I have another big loss because something happened to it. And so that loss increases to 60,000. And then in year 3 or 4, let's say I use 5,000 a piece. And so now I'm back down to 50,000 loss. But then I go to sell the property. Anytime that asset is sold, you get to free up that loss no matter what. So if we're going to have this big gain, well, now all of a sudden we can fully utilize a loss plus have a gain. And that's where having a good tax person that understands real estate is important, because those tax losses that were not used in prior years offsets ordinary income, which is your traditional tax rates. But the long-term gain is taxed at the lower tax rates, which then we can start to play with the numbers. And on average, you're saving about 7% in taxes between long-term and ordinary. So let's say where I've seen a category of someone that it made sense is someone that was like, hey, I'm done with my 401k, even though I know I'm going to pay a penalty. I want to pull it out. Not saying I advise it, always consult your financial advisor, but they wanted to pull it out. They were getting ready to sell a property at the same time. And so we had this carry forward loss that kind of offset everything they took out of the 401k. And in the end, they paid just the long-term capital gain. And so by having those large carry forwards, if it's a net operating loss or the active real estate or active passive loss that's carried forward by property, we can do a lot of tax planning in years of transition. Or, hey, I'm selling, but I also want to do this. Or another great example is I want to convert this last little bit of traditional to a Roth IRA, if anyone's in that category. So there's a lot of ways we can really plan. Now, a lot of times it's important to plan at least a couple months in advance. Don't wait till January 1st and now all of a sudden we've lost those opportunities.
And so you did bring up one more question I had. So my understanding with the long-term versus short-term income or ordinary income or capital gain, is that a year designation? So I guess, for example, so you understand my question, if I'm flipping a house and I held it for 3 months and flipped it and I made a $30,000 profit, is that ordinary income or is that some sort of capital gain?
So flipping versus buy and hold is different. If you were intending for it to be a rental and you happen to sell it within the year, it'd be ordinary. If you intended it for it to be a rental and you sold it after 1 year, then it was a long-term capital gain. If it's hey, I'm flipping this property and you've advertised it to everyone you're flipping it, now it's actually self-employed income. And so that's where, again, coaching with clients, it's like, I'll call Dylan or Nathan or Joe, actually. I just knowing you guys, I know you guys are buy and hold. I know you're not flippers, but if you happen to buy something and sold it within that year, well, my thought is, hey, you just got a great offer. Why not sell it versus you were flipping it? But again, it's all about that story. And so if you bought it and sold it within a month, then we start to say, oh, it's tough. And so that's where coaching on that is important to understand what are your intentions. But yes, going back to the initial question, if you sold a rental less than a year, it's going to be taxed at ordinary rates. If you waited that 1 year and the next day, then it's long-term capital gain rates, which on average you save about 7%.
Okay, that was the 7% distinction you made. Okay, and I'm sorry, I keep thinking of other things. All right, I promise this is my last question. So can you briefly describe how the de minimis strategy works? Because I don't fully understand it. But yeah, I want to hear your thoughts on that and how that can be utilized, and how that differentiates from regular depreciation and the cost segregation strategy.
Yeah. By the way, I just want to throw this out that Joe invited me on here to ask his personal questions, so I didn't bill him any extra. So that's why he keeps asking more and more questions.
Yeah, absolutely.
No, that's actually a really good question, Joe, though. So the de minimis policy, so in 2014, the government passed what is called the tangible property regs, and it took effect in 2016. And through that, so laws didn't really change before and after, but what they did is they defined things more. And so prior to 2016, if you bought let's say a refrigerator for $50 off Craigslist, the rule said you had to depreciate it over 5 years. Well, the government was like, we're kind of getting tired of tracking all these little itty bitty things. And so they kind of said, initially it was, I think, $500. Then they finally said, okay, let's do $2,500. And then if you're a corporation and you have your financials audited, it was actually a higher limit. So the de minimis policy says if a per item is less than 2,500, you can expense it. Now, the caveat is you have to be careful on what's happening to the property. So if I bought a single family, it was not rented, and I intended for it to be fully gutted before I go ahead and rent it, then anything that's done between those timeframes is most likely going to be depreciated. And that's where we have to figure out if it's the 5, 15, or 27.5 years. But I think most people have been on Bigger Pockets, and Amanda Hall that talked about the Burr methodology. Han, maybe it wasn't her, but it was either her or Brandon Hall. That's what it was. Brandon Hall talked about, instead of the Burr, think about it, the bar methodology. So the original Burr is buy, renovate, refinance, or rent, refinance, redo. By adding the A after the B, it's buy, advertise, renovate, rehab. And the advertisement's important. And the reason I bring that up is to take deductions on a property, it has to be available to the public, and it has to be livable. Livable in the IRS terms is kind of crazy in my mind, based upon what I've read through court cases and the rules. An easy general term is, does it have a working toilet? Does it have a working sink? So if you meet the livable, which is those two items, then is it available? Available is, did I put a sign out front? Did I post it to Zillow? Did I have a signed contract already? If I meet both of those, then, when I say available, you don't have to have a signed lease. It's just, could Joe see the property that it was ready to rent? And so if you meet both of those, now all of a sudden certain deductions or items that we had to capitalize or depreciate now can be expensed. Great items like are your appliances. So if per appliance is 2,500 or less, we get to expense. If let's say you were able to do your roof less than 2,500 in total, that's expensed. And so it's a $2,500 rule that just allows you to expense items. And for real estate investors, especially the smaller ones, this rule really helped us all out to be able to expense items. If not, that roof, you would have had to depreciate over 25 or 27.5 years, which at 2,500 divided by that, you're talking $100 a year versus being able to expense. Now, the second piece that's even important is, let's say you're going to sell that property and you were depreciating it, you would have depreciation recapture down the road, versus now with expensing it, it's all long-term capital gains. And so the more we can kind of expense, great. But then going back to a point we made earlier, by expensing them, the banks aren't going to like it as much. So that's where we always have to be careful. What is the plan with the lender? What is the plan with taxes? Yes, we can, in some certain situations, we can get the taxes to look the same if we're depreciating or expensing. But if we can expense it, we should, for that depreciation recapture down the road. But we also have to be careful with the lending. So it's a, Joe could come with something, DJ could come with something, Todd could come with something, And each person, based upon other income, based upon what the lenders are saying, we could come up with a different scenario. Well, we could also come in with the same tax. It's just, do we depreciate or expensing?
Yeah, no, that makes perfect sense. And as you were talking about that, that's exactly what I was thinking. Is the problem with that would be then hurting, lendability, DTI, things like that. And I think that's why it's so important that as investors we really determine our goals, and this leads us into our call in 2 weeks, which is all about goal setting and kind of redefining our goals for next year, with it being the end of the year. But I think why that's so important, and I think that separates a lot of new investors from really successful and scaling investors, is having those really defined goals. Because just like every other piece of investing, your tax strategy is going to be dictated by what you're trying to accomplish. If you're not buying any properties next year, you may not care as much about your income. But if you're trying to scale and grow as an investor, then typically getting loans is going to be a really important piece of your strategy. So yeah, that's awesome. I think that's everything that I had planned to ask, and obviously a lot of things that came up. But feel free, guys, if you have any questions, just raise your hand, or just keep it orderly and go ahead and jump in. You can type or write your questions, and we'll try to keep it to about 12 minutes here of Q&A.
Let me add just one more thing to kind of go off of Joe's, and I'll keep it hopefully 30 seconds or less, so Q&A can happen. By planning or long-term goals, I always see the a self-employed or real estate investor, and it's the graph where it's like, hey, we're having success. Oh crap, we hit a down low. We got some success and we go down. Well, by planning, and it doesn't have to be tax planning, it's just planning in general. Well, now all of a sudden we can see up, and maybe it's only a small drop of because we're planning about with lenders, or we're planning with this, whatever it might be. And so we, instead of having that big drop of, we hit this roadblock, we can't get any more loans. By planning, it's really important is we decrease the downtime. We decrease the next time we get the next property. And again, it doesn't have to be from the tax side. There's plenty of areas that can be planning a good planning on good planning in real estate. And Joe has always impressed me that he's got a person he talks to in the lending, say, hey, what's it going to take for me to get this? And he's just constantly talking to understand, okay, this is what I need to do. And instead of him showing up and they're like, yep, you're denied, he already knows what's going to happen because he's planning.
Yeah, I mean, I think that also leads into a whole nother, we could have a whole nother call on this, but having relationships as well, building relationships with your CPA, with your your insurance broker, with your lenders, whether the residential, commercial, and it could be multiple, but having those connections where as you scale and grow in this business, if you can't shoot a text or a quick call to somebody and get an answer, then you probably don't have the right person in your circle that's going to help advise you, because you're going to run into roadblocks if you don't plan, as Phil just mentioned. And you don't want to get in a situation where you don't know what you're doing and you quit your job and go get another job, and all of a sudden now you got a 2-year start before you can get another loan, and now you just put yourself 2 years behind. And as we all know, with real estate and wealth creation and financial freedom, time is the most important factor on our side. So any delay that you create is going to really shut down your compounding effect on growth. So anyway, let's open it up to questions and get a few in here.
Yeah, I got one. And Phil, thanks for joining us tonight. And I'm new to real estate. I don't have any rental properties yet. So this may be kind of a dumb question, but I'll ask it anyways. With respect to depreciation, you mentioned that something was changing or going down to 80% next year. Could you clarify that for me, please?
Yeah. No, and first off, there is no dumb questions. The government has made the tax code extremely complicated, and I'll be the first to admit I don't even know it all. So so there are no dumb questions. But when we talk about, when I said the 80%, so when we in an earlier example, we were talking about bonus depreciation. If it's a 5 or 15, we can take 100% of that in year one. Without bonus depreciation, we're taking any 5 years over a 5-year period. With a 15, we're taking it over a 15-year period. But that bonus depreciation allows us to take it all in year one. When Trump passed the last tax laws, it was the bonus depreciation was starting at 100, and eventually it started going down to 0. And so 2022 is the last year of 100%. Then it goes down to 80%. And then I believe the very next year it goes down to 60, and then it goes away. And so if you bought a $5,000 appliance in 22, we could take 100% of it this year. If it was bought in 23, we can only take 80% of it, and then the rest of it would be taken over the remaining 5-year period. So that's what the 80% was.
Thank you. Very clear.
So to expand on Angela's question, so that's just for regular depreciation. That's not a cost segregation, right?
That would be for anything that qualifies under the 5 or 15. So, like, excuse me, think of a way, don't use this. I would never use this against the IRS, but an easy way to think of 5 versus 15 versus 27.5 years. A 5-year is things I can remove and reuse. Appliances, kitchen cabinets, countertops, floating floors, carpet. Now, I personally wouldn't reuse carpet, but they specified that out there that you can use it. Those items, if we have to depreciate those because they're over our de minimis policy, or let's say we're doing it for lending, those are items that are going to be that bonus depreciation. The other category is going to be land improvements, anything that I'm improving the land. And so if we had to do a massive retaining wall, those or fence or driveway, those type of items qualify for those bonus depreciation. And so in 22, or from 2016 to 22, we could take 100%. 23 is 80%, then 60%. And it doesn't mean you don't get to use it. It's just the first year is that 100%, 80%, and 60%.
Makes sense. Thank you. Thank you.
Hey, Phil, did you say your office is going to be reaching out about end of year planning?
Yeah, so I was bad about the end of year planning emails, but Max went through 420 of our clients that have real estate and evaluated for cost segregations. And he said he was going to be sending an email out this week. But just give me a call this week or next week, and we can set something up.
Yeah, we'll do. I just have a few questions. Sold a property this year and a few other things.
Sounds good.
Phil, I have a quick question on the cost segregation. Just my rudimentary knowledge coming into tonight's call. Oftentimes in podcasts, basically that would come up on larger commercial buildings, right? So what is it cost prohibitive for doing it on a smaller, a single family, a duplex, something like that? Or where is kind of the bar where that's under consideration versus, not going that route? And then also, what's the methodology? Who's doing that? Is that something that your company does, another company? Just curious. I'm pleading ignorance here on that.
No, those are good questions. So there's lots of companies that will do it. We only do cost segregations for current clients. One, the goal has always been value add, but we've been over the last 6 months built a team that we can add that value add, and we just want to concentrate on our the current clients or new clients, and that being, hey, we're preparing the taxes, year-end planning, whatever it might be. And so we'll do cost segregations for those clients. But the second piece is your first question is going to be very important as you think about, should I do the cost segregation? There's a lot of companies out there that'll do them. I would say a lot of them are going to say 3 to 20 grand, depending on, size, location, how many properties you have in there. And 3,000 might even be on the low side. We currently are on the lower side for those, but we also aren't trying to do the $10 million properties. We're trying to concentrate on what our clients are investing in. And currently we don't have anyone that's investing in, massive. Now, let's say next year Joe decides to buy 2 $10 million properties, then we'll consider it. And, I'd be happy to do that. But yeah, so the key is cost. And so what in our office, what Max has been doing is going through and saying, okay, what was Nathan's tax rate? Okay, what was the basis of this property? Can we get enough tax savings in year one or year two to offset our fee? If we can't, we're going to say, hey, we thought about you, Nathan. It's just we don't think it's the right time. And so what we've kind of realized through going through our strategy is if you're in the 12% or less bracket, so 10 or 12 or no percentage, it might not make sense unless you have a massive property and you're just like, I don't want to pay any taxes. Plus, I want that carry forward because next year is going to be a really big year. So there's, multiple different ways we can look at it. The other thing is we've kind of realized if you're 37% bracket, $100,000 property makes sense. But really, if you're in a lesser bracket, then really we're looking for closer to that $125,000, $150,000 property before it really starts to make sense. Now we can change it again if that year one we're doing it. It can make a lot more sense, but there's certain numbers and or your tax bracket that really starts to sway if it makes sense or not.
Gotcha. Okay. Thank you.
Yeah, and one thing I want to add just from my personal, standpoint, and I mentioned it briefly, kind of my personal strategy, and in years past, I've been less aggressive in trying to minimize my tax liability as close to zero as possible, and I've written some painful checks to the IRS. This year, I have kind of shifted my feeling on that, and I think a lot of that depends on where you're at as an investor. I'm also, at a point where if I can't buy something next year for some reason, I'll be okay. You know what I mean? So I've also hit a place where I'm at peace with what I have, and if I can't, then fine. But with that in mind, I still am trying to plan around being as lendable as possible. And the reason why I think doing cost segregations are so important on certain properties in certain situations is adding as much of that tax deduction back to the depreciation line that then gets added back to your income. The way I look at it is kind of a funnel. Like I can take all of my business income that comes in, put that into buying real estate properties. And obviously this year I was able to buy some bigger properties than I had in the past, taking the deductions from cost segregation on some of the larger properties, and then reducing what I owe from my business income to then save, let's say $50,000 in taxes that I can then take next year and go put into another property. So it's kind of like, a cycle there. But instead of giving that money to the IRS, I'm reinvesting that money. And, I don't know if there's anything you want to add to that viewpoint that I have, Phil, but that's kind of my personal strategy in the way I'm looking at tax planning.
Yeah. And I think, you definitely are. And again, it's the planning. It's, hey, am I lendable? Do I have to, really try and push for the next property because I'm making a life change, or, hey, I just don't, I really, actually a client's like, hey, I need the money by April because I'll be ready to close on a really massive deal. How do we make sure it all works out? And so there's a lot of moving pieces. A lot of it has to come from your personal, what are your goals? Now, the one thing I do want to say is cost segregations is not adding deductions. If let's say a property was able to save you over 27 and a half years, $27,000 due to depreciation. And I'm just making up some numbers real quick, but if over a 27-year period, because you were able to deduct so much per year and that cumulative amount was 27,000, what the cost seg is doing is saying, hey, that 27, we're going to speed up, let's say 30%, 50%, whatever it is, to that year one. And so if we can say in year one, you're saving 15,000, but every other year, you pretty much have to pay back an extra $500 or $200, then, and it's not paying back, it's just less depreciation. And so again, if you're like, I'm comfortable, the lenders are comfortable, and I want to grow, or you want to take your money and put it into a different type of investment, I would highly encourage that cost seg, because one, we know what the laws are today. We can control the money. And two, we don't know what the future is going to hold, and or with the way the market's been from a real estate, if you have that cash today, can it allow you to buy that next property? Or are you going to be regretting saying, hey, I wish I'd have done XYZ because I didn't have that extra 15,000 in cash? And so the key is by speeding up or by utilizing what we know the current laws are, by knowing that I want to continue to invest. And again, it doesn't have to be real estate, just because I know there's a lot. I have a couple of clients that are still very hot in either the crypto or the stock market or whatever it might be. My personal belief is it has to be invested, because you're giving up some of those deductions for the future. So why not, if you're getting it today, utilize it to then grow it so that your time value of money is growing more and more.
Also, and I think another obviously strategy that is probably kind of the next step, especially as you scale, would be, and what I see a lot of bigger and more experienced investors are doing, is that even when they're losing or accelerating that depreciation schedule, and they're keeping more of the income by not paying in taxes, if they were to sell that property, instead of paying the recapture, they are then 1031 it into a larger property, which again kind of keeps that cycle moving that I just kind of discussed. So you're able to trade that up into a larger property, and then obviously we know the accelerated depreciation is ramping down, but like you said, if you sell it and make $1 million gain, and you're not having to repay the depreciation that you had written off, you can then go out and buy a much larger property, and then have even a larger pie to then potentially cost segregate for next year. Is that what you're seeing in the bigger investors?
So I've actually talked one of my bigger investors out of a 1031. But yes, normally I would agree with what Joe's saying. By 1031, you're not paying the tax. But I was able to talk him out, because with losses from other cost segs from other properties, the few properties he sold, we were able to bring him down. So he paid 0% long-term capital gains on the long-term gains that he sold. And so now he got a step up in basis in the new property he bought. So again, coming back to planning, it's important to understand, what's going on. Now, if you're not sure, always pay to do the 1031 and go through that process, because you can always back out of it. But the key is, are you planning? Because if in his scenario, I would rather you pay at a 0% tax rate, get the step up in depreciation, or step up in basis, which then we get a larger depreciation overall. And now you don't have to worry about the next time you go to do a sale or 1031, because you're stepping it up already.
Gotcha. So you don't have to worry about the recapture then with that next property.
Yep.
Awesome. All right. Any other last questions on the Q&A before we get into the group discussion?
Is there a 30-second rundown on the 54 unit? You said partial syndication you mentioned earlier.
Yeah. So it's kind of like a syndication, but it's really not. So it's three guys, myself, the guy I was a 50-50 partner with on a few other properties, and then one other investor. And so it's verbally treated like a syndication, where there's preferred and there's some other things. But yeah, we took the money from 3 of the sales and put it into 54 unit deal, and then brought in a third party to kind of fund the rest of it. And so that's how we were able to get the 54 unit. I actually had to pull myself out of any of the conversations, because I had 2 other clients bring it up to me that they were interested in this property. And so I told my partner, I was like, hey, you're gonna have to do this blind. I can't help you, because I can't just tell these other clients that, like, I told them up front, I was like, hey, I'm an interested party, but I'm pulling away from any of the negotiating, anything like that. So yeah, it's over in Delhi, and it's actually done much better than the projections have overall done. But yeah, we got a 30%, or I wasn't part of the 30%, but I got a fee for kind of doing some of the some of the back end stuff, because of the tax side and everything. But yeah, it was treated well, and it's actually done overall cash flow awesome. So
awesome. When did you
Congrats.
close on that?
August of 21, I believe.
Okay, last year. Gotcha. Awesome.
Yeah. And right now we have 2 4-families up for sale in Roselawn. And that was the ones that we did we were able to buy with a cash out from other properties. And so, we in that business, we have zero cash of our own, and we've continued to just made more, bought more properties. Right now it's like, I think we bought them both for 150 and we're selling each for anywhere from 2 to 250. And that was 2018 to today, when we bought to when we're selling.
Awesome. Well, I appreciate it. Let's shift over to the group discussion, and we'll quickly run through these. And Phil, if you want to stay, you can lead us off here. If you can, I don't know if you see in the chat the questions there. Obviously, I know you covered a lot of it, but anything you haven't covered, mainly any of your short and long term goals.
Yeah. I can say on about another 10 minutes or so. Yeah, I think I covered quite a bit to start off with. Years investing since 2013. Short term, right now the next thing is to sell those 2 4 families, just so that way we can get the cash. Long term, I would say, I would like to get into the commercial a little bit, but then also would like to get that money put into an apartment deal pretty quickly. If it's, with, let's say Joe says something, or someone else, just to keep that money rolling. However, I'm trying to be mindful of where the market's at, because talking to a lot of clients, I've seen some of the prices drop recently. One, I've been meaning to, so what do you hope to get from the group? I've been meaning to get on here a bit more. Joe's been bugging me. And so the 9 p.m. is definitely a tough time for me with 2 kids, 2 years or younger. But I just want to network and get to know people. I just love hearing stories. That's probably the biggest thing. I think getting to know people, going back to relationships that Joe brought up earlier, I think makes an impact, not just on investing, but your overall life.
Now, this 2 you're selling in Roseland, is that something you're trying to do a 1031 with, or what's your plan for this?
Yeah. We talked about doing a 1031. We just don't have anything in mind. And based upon what my partner has been looking at, he didn't feel comfortable doing the 1031. Plus, with the tax planning for him, it doesn't make sense to do the 1031. And so we can't really do it overall. And so we're just going to skip the 1031 on this one.
Gotcha. Okay. Awesome. DJ, you want to go next? Can you see those questions?
Yep. Give me a second. Let me bring them back up here. So DJ Wishmeyer, I'm in Loveland on the east side. Currently I have 2 duplexes up in South Lebanon. Bought them in 2020. Kind of been cruising, getting those, rented out and tenanted and stuff. I've got 4 great long-term tenants. Those were my first 2 that I purchased. And right now I'm just, I kind of got in a rut, so I'm kind of trying to get back in and re-educate and get remotivated. But my short-term goal in the next 1 to 6 months is kind of research. I'm actually reading the best ever syndication book again. So take some notes on that. I'd love to, maybe, small commercial is kind of where I want to go next, is kind of scale up a little bit from where I'm at. So anywhere 5 to, sky's the limit, whatever we can raise or whatever. So long term is, just keep growing that. So from the group is networking as well. Phil, I'd love to get your contact information. So have a chat.
Yeah, and I'll add that to the chat real quick.
Okay. Yeah. Thank you.
See you, Nathan. I know you got to go, man. I'll talk to you soon. Thanks for coming.
Yeah. Current needs on the group. I'm here to talk, and, I think I've met most of you guys at the meetup and both the other meetups too. So.
Awesome. And yeah, Phil, I will, when I post this to the group, I will link your email as well. Colby.
All right. Monthly goals for me. I am working on separating my bank accounts. So I can run one. I've kind of had everything mixed together, so I'm going to try to separate that and get business running through one and my personal expenses running through another one. I'm kind of putting together a budget. And another goal is gather up some documents and get in again to talk with Phil about my tax strategies. I guess that's my next step too. No current needs from the group. My goals last time we were on here was I was getting a fence, so my fence is in and completed. My appliances, so I got a electric dryer now, so that's nice. And calling tomorrow on my other appliance, the microwave. So that's the 3 that I was working on, and I finished 2 of them, hoping to finish up the other one by the end of the week. And then on to the next, probably doing the floors next.
Awesome. Angela?
Yes, sir. So let's see. All right. So my monthly goals, guys, are so I'm trying to get my primary residence rent ready, which pretty much I just got one job left, which is finishing up some baseboards. I want to underwrite. I need to underwrite 15 properties this month to keep practicing, keep getting familiar with the areas in Cincinnati and Northern Kentucky areas. And then not so much real estate, but more of like a mindset kind of thing is I'm trying to finish reading The Power of One more. As far as the most important next steps is to find that deal and make an offer on it and hopefully get it under contract. Looking for 2 to 4 unit multifamily in the Cincinnati or Northern Kentucky area. No current needs from the group right now. And as far as any wins or lessons from since the last meeting, I actually went ahead and calculated how many units I need to get to that first, I'm going to call it financial independence, like level 1, right? So I need 15. That's where I'm at right now. And I think that was really helpful as far as me visualizing and putting an actual number to go after, kind of what we talked about a couple of meetings ago. So that's where I'm at right now.
Yeah, and next meeting, that is going to be the sole focus of our call is I'm going to post in the group establishing our goals and all the things that I want people to think about and work on. And then that next call, the entire call, we're going to be running through as a group our goals and drilling down on how to accomplish them and very specific tangible things that we need to do to accomplish them. So hopefully you guys can make it, because I think that the more experience I get and the more wisdom I get, goal setting, writing your goals, and keeping that at arm's reach has been a massive difference in growing in levels of success in business and in real estate. So anything else you want to add, Angela?
The one thing that I just learned too is that, so I just came back from the UK. I spent 2 weeks out there and I learned that they don't have 30-year fixed mortgages like we do.
Okay.
Right. So we are very fortunate. I mean, they pretty much got arms, 5-year arms, basically after 5 years, they have to refinance. So I guess that we are very lucky to be here in the US investing.
Yeah, that's awesome, Angelo. Joe, I wanted to add one thing just in case I don't make it to the next one about the goal setting. So there's a men's group that I'm a part of that the one thing that really helped me out is you write your goals as if you're a year or 3 years, but you write it as if you accomplished it. And then by having that posted, you're constantly looking at it. And for us, we actually broke it down into spiritual, personal, relationships, professional, and then financial. And so that way you can kind of see it all working out. But I think the exercise by writing it out was you were writing it, and we did it based on 3 years. So you're writing 3 years in advance to yourself, hey, this is what I accomplished. And outside of a couple, I was able to accomplish most of them in about a year and a half, which I think what Joe is hinting at is like, if you can put those goals, sometimes you actually hit them quicker. So.
Yeah. And I think that, I've heard both strategies. Like some people say, make ridiculous goals that are impossible, because then if you get 70% there, you accomplish more than you ever would have. I understand that mentality. But I think, to me personally, what's worked for me is making really difficult goals that are possible, because then I can make a very realistic, footprint as to how do I get down that path and accomplish it. But yeah, obviously that's what we're going to talk about in 2 weeks. Hopefully you guys can be there. Yeah, so I'll quickly run through mine. The only real major change since my last call was we started doing the leasing on the 28 unit for the new apartments that are being available. We had our overwhelming response so far, so that's been very good. We had like 300 messages, I think, in like the first couple of days we posted those, and so that's been awesome. That's definitely gave me more optimism that we'll be able to hit our target rents or even higher. And the quality of tenants that we've had has been higher than I anticipated, because we're kind of right on the fringe of like Clifton and Camp Washington, and the current clientele in that apartment are pretty rough. So I was a little nervous as we transition the tenant population that we would hit some road bumps. But so far, we've already pre-leased 3 of our units that aren't even available. And then we have 2 more that we're working on pre-leasing, and looks like, as of knock on wood, that we're going to be able to basically have those filled as soon as they're available, and hopefully we can do the other 23 units the same way. Any other final thoughts, comments, questions before we wrap up?
Joe, I just wanted to thank you for inviting me again, and then just thank you guys for listening. Hopefully it was entertaining, even though taxes are dry and boring. Just hopefully it was a good overall for you guys.
Yes, thank you so much for being with us, man. I know I learned a lot, and I hopefully everyone else did as well, and everyone else who will watch this video. We appreciate your time, and I will see you guys on the 28th if I don't see you sooner. And everyone have a great holiday.
Yep, you guys as well.
Happy
Thanks a
holidays.
lot, Phil.
Take care, guys.
All right,
See
bye,
ya.
guys.
All right,
See
see
ya.
ya.